In this session, we're going to be looking at what options are best for you: cash, property, shares, or bonds, and how to add them into an investment mix. A little knowledge can go a long way when deciding which investment may suit your tolerance to risk, investment goals, circumstances, and timeframes. And that's why it's important to have some ideas about where your money is going and how your investment mix is made up. And the most common asset classes represent different types of investment: cash, fixed interest, property, and shares. Each asset class has a different level of risk and return, which means they can perform differently over time. On risk and return, when you choose an asset class for your investment, it's important to understand how it works and to be clear about investment timeframes so you're not setting yourself false expectations of how your money should be tracking over time. And when focusing on structuring your investment portfolio, remember investments that have provided higher returns over the longer term may produce a wider range of returns over the short term. And this may mean that these investments may not help you to meet your short-term investment goals. So let's look at the different types of asset classes and the risk level involved. First, cash and fixed interest. Defensive assets such as cash or fixed interest are generally aimed at providing stable, more consistent returns. And with cash, it refers to bank bills or other similar securities, which generally have a short-term investment time frame and provide more stable returns over the short term than some other investments such as shares. Their risk level is low. Now onto fixed interest. These are securities such as government and corporate bonds and generally operate in a similar fashion to loans. You can get a regular interest payment from a bond for an agreed period of time, and the value can go up and down, depending on changing interest rate levels. You get your initial outlay of cash back when the bond matures. Bonds have historically offered returns that are generally more consistent but lower than shares. They still contain some level of risk higher than a cash investment, so their risk level is actually low to medium, and the time frame is a minimum suggested of 3 years. Now on to property securities, Australian and international shares. These are growth assets that are focused on capital growth and income. And with property, this can be bought directly or you can buy it indirectly via property securities. Property securities are usually listed on a stock exchange and traded in a similar way to shares. And depending on the specific security, each property security can represent an investment in a real property in various sectors including retail, industrial, and office. And they have a risk level of medium to high risk and a time frame of a minimum suggested 5 years. And with shares, you can buy shares in companies locally and or internationally. Your money buys you a stake in the company that can be traded on a stock exchange. And this can be done directly or through a managed fund, which will pool your money with other investors to buy shares in various companies. And the value of shares tends to fluctuate, and shares are considered to be more risky than other asset classes. However, over the longer term, shares have historically tended to outperform other asset classes. Their risk level is high, and the minimum suggested time frame is 7 years for both Australian and international shares. See you in the next session. The information in this video is neither professional advice or instruction and is not to be used as such. For specific terms and conditions and rates used in this video, please refer to the PDF download provided. For professional help, please contact John Waters at www.allstarfinance.com.au.